Good morning to you, and welcome back to the Deep Dive. Today, we're not just skimming headlines. We're really taking a deep plunge into the pre-market currents that are shaping, well, everything, your world, your portfolio, the global economy. Specifically, we're pulling back the curtain on the comprehensive pre-market report from Bulls, Bears, and the Bell for Thursday, August 28, 2025. Our mission, like always, is to cut through all that noise, the financial news cacophony, pinpoint the really crucial drivers, and help you understand what this incredibly complex landscape really means for you. Okay, let's unpack this because, wow, we're staring down a day that feels a bit like a high-stakes poker game, doesn't it? On one hand, you've got this underlying hum of market optimism, almost like a continuation of that recent record rally. But at the same time, we're grappling with NVIDIA. The undisputed king of AI, hitting a pretty significant snag after its earnings. Then you layer in fresh global trade tensions, these new U.S. tariffs on India, and maybe most critically, that second estimate of second quarter GDP data dropping right before the bell. It's quite a mix of forces.
And for you, it means trying to figure out the powerful, often contradictory currents running underneath it all. Today, more than ever, the nuances, the why, the what next, they're absolutely key.
What's truly fascinating here, I think, isn't just the sheer volume of information, but the divergence we're seeing in today's pre-market. You've got U.S. index futures broadly positive, painting this picture of underlying resilience, a market that seems eager to extend its record run. But then, right up against that, you see NVIDIA, the AI titan, taking a noticeable hit after hours. That could easily ripple across the whole tech sector. So this immediate tension, broad market strength versus specific critical tech weakness, it really sets a compelling stage for the entire session. And as if that weren't enough, you've got two huge macro catalysts hitting. First, those new U.S. tariffs on Indian exports, which immediately inject, inflationary concerns into the global supply chain. And second, that Q2 GDP second estimate. Everyone's going to be scrutinizing that for what it means for the Federal Reserve. This is exactly where the so what for you, our listener, really kicks in, understanding how these powerful, often conflicting forces are playing out and what kind of market they're actually creating.
Yeah.
The global market pulse. A mixed bag of resilience and concern.
Okay, kicking things off with that global view, our pre-market report describes the U.S. equity market as poised for a cautiously optimistic start. Index futures are mostly green, suggesting, maybe this remarkable record rally keeps going. It feels like there's this ingrained optimism that maybe needs a closer look.
That underlying resilience is definitely there, no question, and it's driving that cautious optimism headline. But for you, the investor, it's vital to peel that back and ask, what's really propping this up? Is it solid fundamentals, or is it something maybe a bit more fragile, like, just hoping the Fed pivots? Because when you look outside the U.S., the picture gets way more complicated almost immediately. It suggests this strength might be pretty selective, not really spread out everywhere.
Right, selective strength. We see that playing out across the Pacific. Asia had a very mixed session. The report says, here's where it gets really interesting because it was truly divergent. Some markets soared, others, struggled. It highlights these distinct regional dynamics.
Absolutely. Let's break that down because the details are pretty insightful. Take Japan's Nikkei 225. It kept climbing, gained another 0.7%, and it's trading really close to those record highs we saw earlier. This strength isn't just fleeting. It seems supported by a pretty positive technical picture and just persistent investor optimism. They seem to be shrugging off those U.S. trade friction worries. It speaks to a strong domestic story, maybe driven by corporate governance changes and the weaker yen helping exporters. It feels like it's building on solid ground internally.
Okay, then you had mainland China. The Shanghai Composite surged 1.1%, trading near decade highs. That really jumped out at me, especially with all the broader concerns about China's economy. What was driving that?
Yeah, that surge was really pushed by, a clear show of state-backed institutional buying, plus very clear government support for key domestic sectors, especially things like advanced manufacturing and semiconductors. You saw it with the chipmaker Cambricon Technologies. Its shares went almost vertical, became the most expensive stock on the Shanghai Exchange. So this isn't just market buzz. It's really underscoring a strategic national goal of self-reliance and tech leadership. Capital is being directed, to hit those policy targets. It's a different driver than just pure organic growth.
But then, just across the water, Hong Kong's Hang Seng Index fell 0.8%. That tells a very different story about the Chinese economy, almost the opposite.
Indeed. The Hang Seng got dragged down by some real wiltness in major tech and e-commerce names. Think Meituan, JDLee.com. These are often seen as proxies for consumer sentiment. So the declines there reflect this growing worry among investors about the actual strength of Chinese consumer spending. While maybe state money is flowing into certain sectors on the mainland, investors in Hong Kong seem much more worried about the average consumer. That's a critical difference for China's broader economic health. It's a clear signal that the recovery isn't even, and it faces some serious headwinds from within.
Okay. Meanwhile, over in India, the BSE Sensex dropped neat 0.7% when it reopened after a holiday. This wasn't just random market noise, was it? Feels like a direct policy hit.
No, not random at all. This was basically investors' first chance to react to those new U.S. tariffs on key Indian exports. It's a direct, almost surgical impact of geopolitics hitting the market. The fear isn't just about the immediate trade hit, but also the potential for these tariffs to, escalate or widen. That creates uncertainty for exporters and the whole economy. And then South Korea, the KOSPI eked out a small 0.3% gain. The Bank of Korea kept rates steady at 2.5%, which everyone expected. However, the technical picture for the KOSPI looks pretty challenging. Some analyses are even flagging a weak sell signal after it broke its rising trend channel. So that suggests some underlying weakness despite the small gain today, maybe more declines ahead according to the chart watchers. So the real puzzle here is how much of these gains are driven by fundamentals versus just sentiment or maybe technical factors that might not last. It's a question of conviction versus momentum, really.
That's a crucial distinction, and it's regional complexity. It's not just Asia. Across the Atlantic, Europe's telling a slightly different story, though still kind of cautiously optimistic. We're seeing broad gains. Stocks, Europe 600 up 0.3%, Germany's DAX up 0.4%, France's CAC 40 climbing 0.7%, even the UK's FTSE 100 up a bit, 0.1%. A more uniform positive start there.
Yeah, that resilience is interesting, especially after the political jitters earlier in the week in France with Prime Minister Bayrou's confidence vote. The fact that markets are moving past that suggests maybe a deeper stability, or perhaps a market that's just learned to live with a certain level of political noise. This positive feeling is helped by recent economic data, like a surprisingly decent Eurozone composite PMI reading that's the Purchasing Managers Index, a key economic health check. It suggests a continued expansion. But critically, we're also seeing evidence of strong foreign capital flowing into the region's debt and equity markets. If you connect that to the bigger picture, it suggests global investors are actively looking for opportunities and maybe see Europe as relatively stable despite the political stuff. It makes it an attractive place for capital that might be avoiding more volatile spots or, stretch valuations elsewhere. They're finding value. U.S. pre-market snapshot beneath the surface of the futures.
All right, diving into the immediate U.S. pre-market, our snapshot confirms that positive feeling we talked about. U.S. stock index futures are definitely pointing to a positive start. We're seeing Dow futures up 0.20%, S&P 500 futures gaining 0.27%, and the NASDAQ Q100 leading the pack up 0.41%. So, broad optimism, but like you said, cautious optimism.
Absolutely. That optimism is reflected across the board, signaling the markets initially shrugging off some concerns. Now, looking at the fixed income market, U.S. Treasury yields are ticking slightly lower. The benchmark 10-year Treasury yield, for example, is down about 1.3 basis points to 4.224%. This move suggests a subtle but noticeable demand for safe haven assets. Maybe investors are seeking a bit of security ahead of that GDP data this morning. But it also points to lingering worries about the political situation around the Federal Reserve. Any hint of political interference, like the recent stuff with Governor Lisa Cook, can push investors towards the perceived safety of bonds. It reflects a deeper unease about institutional independence.
And what about the U.S. dollar index, the DXY? I see it showing some modest weakness. Does that tie into those same concerns?
Yes, the DXY, which measures the dollar against other major currencies, is down about 0.1% to 98.119. And that decline is very much linked to this ongoing discussion about the independence of U.S. monetary policy institutions. When there's perceived political pressure or uncertainty around the Fed, it can chip away at confidence in the dollar as a stable global currency. So the critical question here is, how much is market sentiment really being shaped by this policy uncertainty, this political risk, versus just pure economic data? It's a key distinction for figuring out the market's true stability today.
Moving to commodities, it's a bit of a mixed bag, some divergence. Crude oil futures are slightly lower, WTI and Brent both down maybe 0.30, 0.4%. But then gold futures are just flat, holding near $3,390 an ounce. What's driving that split? Feels like two different stories.
You're right, it is a tale of two commodities. The softness in crude oil is actually quite revealing. It suggests investor focus is shifting away from those geopolitical supply risks, Middle East tensions, production cuts towards the very real possibility of a global supply glut as the summer driving season winds down. Less demand for gas, potentially more supply coming online. The market's bracing for maybe an oversupply, pushing prices lower. Meanwhile, gold being flat, despite all the uncertainty in the slightly weaker dollar, signals a wait-and-see approach. Investors are probably holding back on big moves in gold ahead of key data, especially GDP. Gold usually likes uncertainty and inflation fears, but today it seems to be pausing, waiting for clearer signals on the economy and the Fed before making a move. It's holding its breath. 3. Top market narratives and catalysts. The day's defining battle.
Okay, let's dive into what will likely be the defining battles of the day, those narratives that will really move things for investors. First up, what our report calls the NVIDIA paradox. I mean, for months, NVIDIA has been the undisputed AI leader, pulling the market rally along almost single-handedly sometimes. It's been quite a run.
That's right. NVIDIA has really been the spearhead for the whole AI theme, driving huge gains in tech and setting the tone for the broader market. Now, looking at the headline results from their Q2 earnings, you'd think it was just a home run. Total revenue, $46.7 billion, EPS 1.08, both easily beat Wall Street forecasts. Objectively, by almost any standard metric, these were strong numbers.
So if they beat forecast, why the immediate, sting of a sell-off, stock down 2%, maybe 3.2% after hours? Is the market really that sensitive to a tiny miss? Or is something deeper shifting under the surface that the headlines don't show? This feels like the core of that NVIDIA paradox.
That's exactly it. What's truly fascinating and very telling is that while total revenue and EPS looked great, the critically important data center division revenue, the heart of their AI story, the engine everyone watches, came in at $41.1 billion. That's slightly under the $41.3 billion consensus. Just a $200 million miss, yes. But for a stock that's been on such a tear, priced not just for excellence, but for, frankly, perfection, even a tiny deviation is a big deal. And then there was the forward guidance. While it looks solid in absolute terms, the market saw it as merely in line. It suggested cooler growth, not the explosive expectation-smashing figures we've just gotten used to from NVIDIA. It's like a sprinter who always breaks world records, then runs a personal best but doesn't break the record. It's still amazing, but it disappoints relative to the crazy high bar they set. And for you, the investor, this signals a really crucial market transition.
So what does this all mean for you, the individual investor, trying to make sense of it? What's the deeper takeaway from this NVIDIA paradox?
It signals a key market shift. We're moving from that initial phase of euphoric, almost buy anything AI phase to a much more mature, more discerning stage. This new stage demands sustained, flawless execution, especially from the leaders. For a company like NVIDIA, with its staggering $4.4 trillion valuation, just being objectively strong isn't enough anymore to keep pushing the stock up consistently. The market had, seriously, priced in perfection. Any deviation, even a small one, gets hit with selling pressure immediately. And the deeper insight for you is this. What we're seeing isn't just an NVIDIA hiccup, it's the market moving the goalpost for the whole AI sector. It's signaling that the era of writing one stock, one theme might be fading. What's emerging is a demand for broader leadership. The rally's engine might need to change from a single rocket booster to maybe a wider jet engine. It forces you to ask, is your portfolio ready for that kind of shift?
That's a big thought. And it makes me wonder how much this sensitivity plays into our next big topic, given NVIDIA's huge weight. I mean, 8.1% of the S&P 500, 12% of the NASDAQ 100. That creates a major test for the market's overall health, right? Does this fragility exposed by NVIDIA make the market even more vulnerable to these bigger macro forces?
It absolutely does. You nailed a critical point. For months, this rally has been narrowly led by just a handful of AI-focused mega caps, with NVIDIA as the ultimate leader. The question now is, can the rally successfully broaden out? Can it find strength in other sectors, other names? Or are its fortunes still completely tied to the momentum of its AI champ? Today's trading will be a crucial litmus test for exactly that question, amplified by those macro forces you mentioned.
So as the day plays out, how do we read this test? What are the key signals investors like you should watch to see if the market is broadening or still just leaning on NVIDIA?
Well, the difference between the negative feeling around NVIDIA specifically and the generally positive futures market sets up this really interesting intraday battle. A truly constructive signal, showing healthy rotation and broader market participation, would be if the S&P 500 actually manages to advance today, while the NASDAQ 100, where NVIDIA has that huge 12% weight lags behind or even goes down, that would suggest other sectors are stepping up. On the flip side, if NVIDIA's weakness ends up dragging the whole market lower, especially the tech-heavy indexes, it would just confirm the rally's underlying fragility and its dependence on those narrow drivers. And this dynamic will inevitably have ripple effects on other AI players' competitors, partners like AMD, Broadcom, Taiwan Semi. It's not just about NVIDIA's stock, it's about confidence in the whole AI growth story.
Fascinating. Okay, let's pivot to the second major battle, the one that really tests the market's resilience, what the report calls the macro crucible.
This is where geopolitics, GDP data, and Fed policy all collide today. First up, those new U.S. tariffs on Indian exports. Sounds like that could throw a real wrench into global trade.
It definitely could. The administration's decision to double tariffs on a range of Indian exports, gems, jewelry, textiles, auto parts, officially took effect today. It hits about $36 billion in trade, which isn't trivial. This protectionist move immediately adds a new and potentially significant source of inflationary pressure globally. This is critical because it directly complicates the fight against rising prices, pushing up costs for U.S. businesses and consumers. And as we saw, it already helped trigger that sell-off in Indian markets, showing its immediate impact. The key insight here is these aren't just headlines. They're direct inputs into the global inflation math.
And domestically, we've also seen these worries about the Federal Reserve's independence. Our sources mention the administration's recent attempt to remove Governor Lisa Cook. How much impact does something like that, a political move, really have on market sentiment today?
That political maneuver definitely created a significant layer of uncertainty around U.S. monetary policy's future. When there's even a perception of political interference in an independent institution like the Fed, it can erode investor confidence, not just in the Fed's impartiality, but in the broader stability of U.S. economic institutions. This kind of uncertainty can weigh on the dollar, like we saw, and, more broadly, raise basic questions about policy predictability. It adds another layer of risk to the market's nervousness, making investors maybe more hesitant, more reactive.
Okay, all of this creates a tense backdrop for today's main event, the 8:30 a.m. Eastern release of the second estimate for Q2 GDP. The first estimate, last month, showed a surprisingly strong 3.0% annualized growth. That sounded pretty good on the surface.
It did sound good, and that's precisely why it needs that deep dive. It's crucial to remember that 3.0% number was widely seen by many economists almost right away as an economic mirage. It was largely driven by a weird quirk, a sharp tariff-related collapse in imports. Imports are subtracted in GDP math, so fewer imports artificially boosted the headline number. It wasn't really strong underlying demand. Key measures of actual private demand, like final sales to private domestic purchasers, were much weaker, up only about 1.2%. That suggests a much softer reality under the hood. So the market kind of knows this number was likely inflated. The question is just how much it gets revised down.
So if the market already thinks the first GDP number was a mirage, what kind of revised number do investors actually want to see today? Feels like we're still stuck in this bad news is good news mode where weakness is actually welcomed.
It's a weird dance, isn't it? Like cheering for a bad report card hoping the teacher cancels the final exam. The market is absolutely locked into this bad news is good news mindset for economic data right now. Investors are actively looking for any sign of a cooling economy to strengthen the case for the Fed to start cutting rates. Right now, market odds for a September rate cut are already sky high, like 87%. But here's the critical question for you, the investor. Are those odds built on solid ground or just wishful thinking? And what happens if the GDP data is just okay, not bad enough to force a deep cut, but not good enough to rule one out? That ambiguity could be the market's worst enemy today.
That really sets up a clash of narratives then. Markets desperate for weak data for rate cuts, but also new inflation pressure from tariffs. Which story do you think wins out today? What are the scenarios for the market's reaction?
Yeah, the market's reaction to GDP will tell us a lot about which narrative has more power right now. A big downward revision to Q2 GDP, especially in consumer spending or business investment, would likely be seen as bullish for stocks. Why? Because it increases the odds of a bigger rate cut, maybe even 50 basis points. That's the Fed pivot story winning. On the other hand, those new India tariffs are pushing in the opposite direction, suggesting inflation could be stickier even if growth slows. That's a dangerous mix. So a strong rally on weak GDP confirms the Fed pivot thesis is driving things. But a muted or even negative reaction to weak GDP, especially if tariff worries are prominent, could signal that fears of stagflation, that toxic mix of slowing growth and persistent tariff-driven inflation, are starting to take hold. That would be a much tougher, much scarier environment for stocks, and one maybe not everyone is ready for. 4EV, stocks in the spotlight, pre-market movers.
All right, let's shift focus to the individual stocks making waves before the bell. We've got some big movers, both up and down. Started with the gainers, MongoDB, MDB showing a huge pre-market surge, nearly 38%. That's a massive move.
It really is, and it shows that strong company-specific news can still cut through the noise. The database software firm reported just blowout Q2 earnings and, crucially, raised its full-year guidance way beyond what analysts expected. This kind of exceptional performance is giving a major lift to the whole software sector. You're seeing positive spillover in names like Salesforce, Datadog, Snowflake, and pre-market trading. It shows that even with NVIDIA stumbling a bit, the appetite for high-growth, quality software is still very strong, especially when they execute perfectly.
And in retail, a rare bright spot. Kohl's, KSS, is seeing a remarkable 24% pop. That's definitely a surprise given how tough things are for department stores. What's their story?
Yeah, it's a surprising outlier in a tough space. Kohl's delivered better than expected Q2 results and, importantly for confidence, improved its full-year guidance. It's a rare bit of good news for department stores, suggesting maybe their turnaround efforts, loyalty programs, inventory management, customer experience are actually starting to work with consumers. It's proof that specific management choices can make a real difference, even against strong sector headwinds.
Then we have Canada Goose, GOS, up over 16%. What's driving that big jump for the luxury coat maker?
That surge in Canada Goose comes from a CNBC report saying the company has received multiple bids to be taken private. This highlights the continued, maybe even growing interest from private equity firms and consumer sector assets, especially brands with strong recognition and global appeal that they think are undervalued publicly. PE firms see a chance to take them private, maybe restructure, optimize, and then potentially sell them later for a nice profit. It shows a belief there's hidden value in certain consumer brands.
Eli Lilly, LOY, also seeing a modest gain, about 1.00%. Sources point to an HSBC upgrade.
Yes, HSBC upgraded Eli Lilly to hold from reduce. They cited successful trial results for its diabesity drug that's a combo treatment for obesity and type 2 diabetes. This is a therapeutic area attracting huge investor interest because the market potential is just massive and growing. Success in trials reinforces Lilly's leadership here and suggests the long-term growth story is intact despite market ups and downs. And CoreWeave, CRWV, also up 2.000%. Cantor Fitzgerald started coverage with an overweight rating, specifically citing AI growth trends. It shows the AI story isn't dead, just getting more selective, favoring companies with strong execution in the ecosystem.
Okay, now let's look at the other side, the notable losers this morning, reflecting some specific issues and caution. Unsurprisingly, NVIDIA is on the list, down 1.63% after hours, backing up our earlier chat.
Right.
But we also have Li Auto, LI, down significantly, over 8%. What's happening in the EV space there?
Li Auto reported its Q2 2025 results. And while revenues were up a solid 16.7% from Q1, showing quarter-over-quarter growth, they actually decreased 4.5% year-over-year to about RMB 30.2 billion. That year-over-year decline is likely what's spooking investors. It signals concerns about the intense competition in China's EV market and maybe softening consumer demand. The negative reaction will probably weigh on the whole EV sector today, highlighting that the road to profit and growth in EVs is definitely not smooth.
And Krispy Kreme, DNUT, down 7.00%. What's going on there? I thought they had a big partnership announced not long ago.
Yeah, that decline is directly because JP Morgan downgraded them to underweight. They specifically pointed to the negative business impact of canceling that partnership with McDonald's. This really shows how tangible strategic decisions, or suddenly reversing them, can hit market value immediately. The market was clearly counting on that partnership to boost Krispy Kreme's reach, and canceling it leaves a big hole in their growth plan, highlights how important partnerships can be and how quickly the market punishes strategic stumbles.
Keurig Dr. Pepper, KDP, is still falling, down 18% cumulatively now. This one's been under pressure for a bit. What's the main issue?
Indeed. The stock is still facing heavy selling pressure after announcing that huge $18 billion deal to buy JDE Peet's, the coffee company. Investors are clearly worried about two main things. First, the big pile of debt that comes with such a large acquisition, especially with higher interest rates now. Second, the complexity of their plan to then split the company into separate coffee and cold beverage businesses. It's just a lot of moving parts, creating uncertainty about future cash flow and operations. It's a major strategic shift, and the market often takes time to digest complex moves like this, especially involving more debt, leading to this prolonged pressure. And finally, JM Smucker, SJM, down 4.44% after reporting Q1 net sales that missed estimates. Often happens when cost inflation mates consumer pushback on prices, squeezing margins and sales, via upcoming catalysts and corporate developments. Beyond today's open...
Okay, beyond the immediate pre-market action, there's a full slate of catalysts and corporate news coming up that will keep shaping sentiment today and maybe beyond. Let's start with today's earnings. We've got some crucial pre-market reports coming from retailers like Best Buy, Dollar General, and Burlington Stores. Seems like they'll give us a really specific read on the U.S. consumer.
They absolutely will. These reports aren't just about the companies themselves. They'll offer a critical, multi-layered look at consumer health across different income groups. Best Buy gives us insights into discretionary tech spending. Dollar General shows how budget-conscious shoppers are doing. Burlington Stores highlights trends in discount clothing. Their results will be closely watched for spending patterns, inflation's impact on non-essential purchases, and, really importantly, inventory levels are stores stuffed or lean. It's a broad consumer health check. In food and beverage, we'll hear from Hormel Foods and Brown-Forman, giving updates on food inflation and demand for essentials versus things like spirits. Brain-Forman is especially interesting after analysts raised concerns about their distribution system changes, so we'll watch for any comments on how that's affecting sales.
And then after the market closes today, another group of influential tech companies report. This should give us a second look at those themes from NVIDIA, right? A broader check on the AI ecosystem.
Absolutely. Reports from Dell Technologies, Marvell Technology, and Autodesk will be really important. Dell's comments on enterprise hardware spending and Marvell's results, particularly in the data center market, will be seen as key follow-up data points after NVIDIA's slight miss. These reports could either confirm a broader slowdown or maybe suggest NVIDIA's issues were more company-specific. That will influence confidence in the whole sector. Plus, rounding out the consumer picture after the close, we get reports from Ulta Beauty, Gap, and Petco. Ulta is a key indicator for the beauty category, which often holds up well. Gap will be watched for any signs of life in apparel, and Petco gives a read on the pet care market. Each offers a unique view on consumer spending priorities.
Okay, beyond earnings, we also have some significant M&A and corporate actions. Menzies Aviation completed its $305 million acquisition of G2 Secure Staff. What's the bigger picture there in aviation services?
Yeah, this is a strategic deal that significantly boosts Menzies' presence in the U.S., the world's biggest aviation market. It basically doubles their footprint to over 110 locations, cementing their position as a top global player. It's a clear consolidation move, suggesting they believe travel volumes will keep growing and that scale brings efficiencies. Also, shareholders of PharmChem officially approved its acquisition by Alcohol Monitoring Systems, closing today. Another consolidation in a niche market.
And going back to Keurig, Dr. Pepper, KDP, you mentioned the pressure after the JDE Peet's deal. With all that going on, how much longer do you think this debt and the planned split will weigh on the stock? Is there a light at the end of the tunnel?
That's the million-dollar question, isn't it? It really highlights the challenge of these huge strategic shifts. The market is clearly uncomfortable with both the increased debt, a big deal in this rate environment, and the complexity of splitting the business. Investors generally hate uncertainty and complexity. It's a big gamble, and it often takes considerable time, maybe quarters or even years, for the market to fully digest and confidently value these complex moves, especially with more leverage involved. So while there could be long-term value, the short to medium term might stay pretty volatile for KDP.
Another interesting development in the S&P 500 shuffle. Interactive Brokers, IBKR, officially joins the S&P 500 today, replacing Walgreens Boots Alliance. Seems purely technical, but what does it mean for investors?
It might seem technical, but it's actually quite significant for the stock itself. This change forces a huge number of index-tracking mutual funds and ETFs to buy IBKR shares. These passive funds have to rebalance to match the new index, creating this powerful, though temporary, technical tailwind and increased demand for the stock. For existing IBKR holders, it's often a positive catalyst, pushing the stock up due to this forced buying. And conversely, Walgreens will see selling pressure as funds unload its shares. It's pure supply and demand driven by index rules.
Lastly, let's touch on the analyst ratings desk. These can often sway sentiment, sometimes pretty quickly. Zacks added 5 new strong buys today.
Yes, the quant firm Zacks added Astronics Corp., Boyd Gaming, Bank First, Futu Holdings, and Farmers National Bank Corp. to its top Zacks rank #1 strong buy list. These upgrades are mostly based on positive revisions to their earnings estimates, suggesting analysts see improving fundamental outlooks for them. Elsewhere, we saw Eli Lilly get that pre-market lift from the HSBC upgrade we discussed. Conversely, Krispy Kreme trading lower after the JP Morgan downgrade linked to that canceled McDonald's deal, showing the immediate impact of strategic missteps. And CoreWeave got a boost from Cantor Fitzgerald starting coverage with an overweight, showing continued confidence in AI infrastructure. On the downside, SBA Communications fell over 4% yesterday, partly blamed on a Bank of America downgrade from buy to neutral, often signaling valuation concerns.
And even with those new U.S. tariffs on India making things tricky, are analysts still finding opportunities there? Does this just highlight the importance of stock picking?
It absolutely emphasizes that. Even with those tariffs creating a tough macro picture, Analysts at Nuvama Professional Clients Group are finding specific stock opportunities in India. They've put BUY ratings on Nitaka, Keynes, and Dr. Reddy's Labs, citing favorable technical chart patterns that suggest potential upside despite the challenging backdrop. This underscores a crucial point for you, the investor. Macro headlines paint a broad picture, but good analysis can still find compelling opportunities based on company specifics, technicals, or unique positioning. It's about finding the signal in the noise, even when the noise is really loud.
Wow. Okay, what a landscape we've covered today. Feels like we've navigated a pretty complex maze before the opening bell even rings. So, to recap the big themes, we've got this fascinating tension, right? Broad market optimism may be fueled by Fed hopes, clashing with NVIDIA's specific struggles, which could signal a shift in tech expectations. We navigated those macro cross-currents, geopolitical tariffs, adding inflation worries, the nuances of that GDP data, and those critical, politically sensitive Fed expectations. And we've seen pre-market movers are being very selective, rewarding strong execution while punishing mistakes or maybe just stretched valuations. So what does this all mean for you as you think about your next steps? We've definitely seen a fascinating tug-of-war playing out this morning.
If we connect this to the bigger picture for you, it's really a powerful reminder that beneath the headlines, market up, market down, the details truly matter. Understanding the nuances of earnings reports, not just the headline beat or miss, but the divisional stuff, the guidance. Understanding the real implications of economic data beyond the first number. And the role of global events like tariffs and politics. It's all absolutely essential for navigating these complex, often contradictory waters. The market isn't just one thing. It's like a tapestry woven from countless threads. Understanding those individual threads is how you get a genuine edge. It's about looking beneath the surface, understanding the real drivers, not just reacting to the latest flash.
Indeed. And as we watch how today unfolds, especially with NVIDIA's performance and what that revised GDP report really tells us, here's something to think about. Is the market's current optimism a broad-based, sustainable shift? Does it signal real underlying health, finally breaking free from relying on just a few names? Or is it still mostly dancing to the tune of a few big players and that ever-present, almost desperate hope for a Fed pivot, making it vulnerable to any unexpected macro news? What stands out to you is the single most critical signal to watch today, the one that will tell us which narrative is really winning. We invite you to ponder that as the market opens, and we look forward to diving even deeper with you next time.